Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And on today's episode, I want to talk to you all about the Qualified Business Income Deduction. I'm going to continue that tax theme back in episode 47. I talked all about, in general, how the federal tax code works. Episode 49, I talked about the differences between the different business entities you can choose and the differences in taxation within each entity. And on today's episode, I'm going to touch on something I mentioned in both of those, and that's the Qualified Business Income Deduction. I'm going to talk about what that is, what is the QBI deduction, how does it work with different business entities, what are some of its limitations, because there are definitely some limitations to keep in mind. And then finally, what are some planning points to keep in mind? So let's dive in. And if anyone has any questions on any of this, of course, you can reach out to me by email. You can reach out to Evon, E-V-O-N, at optometrywealth.com. But there's a lot to dive into, so let's go ahead and just get started. First of all, let's talk about what is the Qualified Business Income Deduction. The QBI deduction is something that came about back in 2017 when President Trump signed the Tax Cuts and Jobs Act. And it's a 20% deduction on qualified business income for owners of pass-through type businesses. If you remember from that last episode, a pass-through type business is anything that's not a C corporation or anything that's not taxed as a C corporation. So that's a sole proprietorship, partnerships, by default an LLC, because by default an LLC is going to be taxed as either a sole proprietorship or a partnership if there's more than one owner, and then S corporations. So those are all pass-through entities, and the reason they're called pass-through is because those businesses don't pay their own tax. Even if they file their own tax returns, which partnerships and S corporations do, they don't pay their own tax. All of that business profit, all of that taxable net income passes through to your personal tax return. So this QBI deduction, this 20% deduction on qualified business income, is for you if you're the owner of a pass-through type business. And this includes private practices. This also includes independent contractors or anyone that's got some sort of side hustle or a side business that you're building up. Maybe it's educational content, maybe it's YouTube, maybe it's podcasting, whatever that may be. If you have some type of pass-through business, you're eligible for this deduction. Again, this was created back in 2017. And the reason it was created was because in that law, C corporations were given a permanent flat corporate tax rate of 21%. And permanent meaning until Congress changes it again. But so C corporations were given a flat corporate tax rate of 21%. And this QBI or 199A deduction, if you're a tax nerd and like to know about what section of the law it's in, this QBI deduction was added to create some balance between C corporations and all the pass-through type businesses. So there wasn't this big rush of businesses changing their structure to C corporations just for that lower tax rate. So it was originally available back in 2018, and it's set to expire or sunset at the end of 2025, meaning that barring an act of Congress to extend it, from 2026 and beyond, this deduction, this 20% deduction, will no longer be available. Will Congress extend it? I don't know. I'm not willing to take a bet on what a future Congress may or may not do. So that's our time horizon right now. That's our planning time horizon. It's between now and through 2025, we get to take advantage of this potential 20% deduction on qualified business income, QBI. So what is QBI? What does that actually mean? Well, the legal way it's described is that it's the net amount of qualified items of income, gain, deduction, and loss for qualified trade or business. In plain English, basically, it's essentially your net income, your taxable net income from your business, from the operations of your business, specifically from the operations of your business. So it does not include capital gains or losses that aren't directly connected to the activity of your business, or investment dividends or interest. QBI also does not include reasonable compensation or the salary or wage that you pay to yourself as the owner of an S corporation. It doesn't include guaranteed payments to partners in a partnership, or any other payments to partners for services rendered to the partnership. So any employee type work. This is specifically for the profit, the net income that you're going to find connected to the activity of your business. And it includes whatever would have been included when calculating your business net income for taxes. So it's going to include any depreciation expense that you deducted or any other business deductions you took for tax purposes. So you're generally going to find this in the Schedule C if you are a sole proprietorship or a single member LLC, or your K1. And if you have a loss, meaning you have negative QBI, you obviously don't get to take the deduction in that year, but that loss also carries forward into the next tax year and offsets next year's qualified business income. So it will lower next year's QBI as well. So where do you find this 20% deduction? You're going to find it on the front page of your 1040 federal tax return. It's going to be on line 13, just below the standard or itemized deduction. And what's important about that is it's below the adjusted gross income line. So it won't help you lower the adjusted gross income. Whereas a lot of deductions or credits or tax benefits or additional taxes are based around that AGI, adjusted gross income number. So it's good to try to lower that where you can, where it makes sense in your tax planning. This 20% deduction is below that, and it won't help you lower that AGI. But it does lower taxable income, and it does help you pay less in taxes. So that's what the QBI deduction is. That's a little bit of the history behind it, when it's set to expire, what exactly QBI means. And let's talk about some limitations, because there are some important limitations to figuring out if you actually qualify to take the deduction or not. There are two really important limitations for you to keep in mind. And first thing to say is that the limitations or your ability to qualify to take this deduction are based on taxable income, which is interesting because a lot of the other tax deductions, tax benefits, ability to contribute to retirement accounts, IRAs, credits, additional taxes that come in, a lot of those are based on your adjusted gross income. That usually is sort of the anchor point for a lot of these different tax benefits or tax issues. But this qualified business income deduction is based entirely on all around your taxable income and taxable income before this deduction. So as if this deduction wasn't taking place. So the first limitation to keep in mind that applies to anybody is that your QBI deduction is 20% of the lesser of your qualified business income, which we just talked about, or your taxable income before QBI, and also minus a few adjustments, capital gains and qualified dividends. So it's 20% of either your QBI, your qualified business income, or your taxable income before QBI, minus a few adjustments, whatever of the two is lesser. And where this comes into play is that if your practice income is the only income in your household, or by far the largest amount of income, then your taxable income is going to be lower than your QBI, most likely. And so it's going to be 20% of your taxable income. And the reason that is because your taxable income, as we talked about in episode 47, where we went through that federal tax formula, your taxable income is all of your other income, your practice income, wages, whatever it may be, is all of your income minus a bunch of deductions, right? So by definition, your taxable income is going to be lower there. If you have other income in the household, so maybe your spouse is working, maybe you have a bunch of other businesses, maybe you have other investment income, rental income, whatever it may be, then there's a pretty good chance that your QBI is going to be lower, right? So that's usually where that comes into play. And interestingly, if your practice is your main source of income, by adding more income, and increasing your taxable income, you may actually increase the QBI deduction in some cases. So it's sort of interesting to think about. But so that's the first limitation. It's 20% of either your QBI or that taxable income amount before the deduction happens. The second limitation is important as well. And it's important because as optometry practices, you are labeled what's called in this law specified service trade or businesses. Basically, in the law, it lists out a whole bunch of service type businesses, and it says that there are very specific limitations or phase outs for you to qualify for this QBI deduction if you are one of these service businesses. So it's pretty broad. It covers most of us. Healthcare businesses, financial services, financial planning. So we're within that category. Somehow architects and engineers were excluded from that list. Not sure how that happened. Maybe they had better lobbyists than we did. But as specified service businesses, we are subject to a very specific phase out rules. And so how this limitation works is that in general, if your taxable income gets to a certain point, meaning the taxable income before that QBI deduction gets to a certain point, then you start to phase out of the deduction, meaning that you start to, the deduction gets smaller and smaller. And if your taxable income gets even higher up to another point, then you lose the ability to take the deduction altogether. And where those points start is if you're married, that floor, meaning the initial part where you start to phase out, is $364,200 in 2023. And the very top of that phase out range is $100,000 later. So $464,200. If you're single or filing taxes any other way, your floor is $182,100 of taxable income, and the range is $50,000. So $232,100 is the very top of that. So what that means is that if you have taxable income, again, before this deduction, below those numbers. So if you're married and your taxable income, meaning all of your income in the household, including spouses, including other business income, including investment income, minus standard deduction, minus other deductions, if your taxable income is below these numbers, then you can take your full 20% deduction, right? So you're not subject to any limitation. You get your full deduction. But as soon as your taxable income starts to get to the floor of those phase out ranges, so $364,000, $182,000, as soon as it starts to get to that level, then you start to phase out. And once you get to the very top of that, then you lose the ability to take this deduction altogether. And for a specified service business, if you're within these phase out ranges, which is actually the start of the 32% marginal tax bracket. So if you're starting to get into the 32% tax bracket, you're starting to think about this type of planning here. So if you're within these phase out ranges, you are subject to a pretty complicated phase out formula that I'm not going to bore you with the math here, but I want to say that it depends on two things in order to phase you out of this deduction. Number one, based on how much wages in total you're paying in the practice, including your own wages if you're an S corporation owner and you're paying yourself a salary. So that's the first factor. How much wages are you paying in total in the practice? And the way that works essentially is that the first limitation is that your QBI deduction is the lesser of 20% of QBI or 50% of W-2 wages in the business for an optometry practice. So there's going to be that first limitation based on the amount of wages you're paying in the business. Now, it's very likely half of all the wages you're paying in your practice are greater than 20% of the QBI, so this may not really be a limitation for you. The second limitation is based on how far into that phase-out range your taxable income is getting into before this deduction. Or another way to say that is how much more taxable income you have above and beyond that floor, that initial threshold number. And if you're getting 60% into this phase-out range and you're closer to the end of it, that's how much you're going to adjust these other things. If you're 20% into the phase-out range, that's how you'll adjust the other things. So there's a formula that blends these two limitations, these two factors together in order to figure out how much of this QBI deduction you actually qualify for in this year. And this deduction is calculated separately for each business you own. So if you own several businesses, each business is going to have its own QBI calculation. And if you are a co-owner or a partner with other owners in a practice or other owners in a business, then each owner gets to calculate this on your own personal tax return. So you may see a point where one or more of you may not qualify for this or start to phase out for this deduction, and the other fully qualifies based on your own personal taxable income. So that's in general some of the main limitations on being able to qualify for this. I want to touch on how this works with different business entities because it's a little bit different between the few of them. So when you are a sole proprietorship or a single member LLC, by default, you're taxed that way. Your entire net income from self-employment is eligible to be QBI, right? So you get to take this deduction, subject to these limitations, you get to take this deduction on the full amount of your net income there. There is one caveat to keep in mind in that although all of your net income from self-employment is eligible to be included in QBI and eligible to be included in that calculation to get that deduction, you do actually have to subtract out a few deductions that you get to figure your qualified business income before multiplying it by 20%. And you have to subtract out your pre-tax self-employed retirement plan contributions. So solo 401ks, SEP IRAs. You also need to subtract out your self-employed health insurance premium deductions, your the deductible half of self-employment taxes. So you need to subtract out these deductions that you get before you multiply it by 20%. So it actually will lower. Those deductions are good, but they'll actually lower the amount of your QBI deduction. I'll talk about this more in the next section when I talk about planning considerations, but something you need to keep in mind here. Partnership is generally the same, although as we talked about earlier, guaranteed payments, which are sort of like a partnership version of salary or like what you would pay someone for like work in the partnership. It's often used as a way to balance out the way you want to distribute profit between different partners. Guaranteed payments are not eligible for this. So only your portion of the partnership net income after your guaranteed payments are eligible for the QBI. S corporations are quite a bit different. As we talked about in episode 49, when we talked about these different entities. S corporations, when you are the owner of an S corporation, you have a requirement to pay yourself a reasonable wage as an employee in the practice. So as a full-time optometrist, if you're working full-time, but also the work you do as a manager and an administrator, you have a requirement to pay yourself the first dollars out of that practice to you have to be that reasonable wage. And that reasonable wage, that salary, does not qualify for this QBI deduction. You can only take a QBI deduction on the net profit of the business. So above and beyond that reasonable wage that you pay yourself. So where a lot of times, really this is where independent contractors have to think about this. A lot of times where businesses are going from a single member or a partnership LLC and are choosing to be taxed as an S corporation. They're doing that to lower the amount of self-employment taxes you're paying because that profit is not subject to self-employment taxes. Only that salary, the wages, only the wages are subject to employment taxes. So you're lowering on the one hand self-employment taxes, but on the other hand, you're also lowering your qualified business income deduction. So there's more things to balance than just one or the other. So S corporations work a little bit differently. There's that salary that's acquired in the business. So those are a few different quirks on how it works in those businesses. Now let's talk about a few planning thoughts, some things to think about when you are planning for this qualified business income deduction. Well, the first thing I want to say is although we've talked about a lot of different details, make sure you talk with your personal tax professional and your financial advisor to learn about how this QBI works with your personal life. It's a really complicated, or it can be a really complicated deduction to plan around. especially if your taxable income is at those higher ranges. I wish it were as easy as it's 20% of your net income. Unfortunately, it's not. It's 20% of this, or maybe that, plus add in some phase outs and eventually you phase out altogether. So it can be a pretty complicated calculation, and there can be a lot of things that can impact it. So talk with your professionals to see how to take advantage of it in the best way possible. And the first planning thought to keep in mind is maybe an obvious one, but it's to plan carefully around your taxable income, because this QBI deduction is anchored on your taxable income before the deduction. That's how you know you're eligible. That's how you start to phase out. So plan carefully around that taxable income. If you're very well below it, if your taxable income is very well below those thresholds where you start to phase out, then there's really no special planning that needs to be done with your taxable income. It is what it is. You're going to get that benefit. But once your taxable income starts to get into that 32% tax bracket where you start to phase out, then you want to plan carefully. You want to, at a minimum, try to keep yourself out of there. Or if you're already getting into it, try to lower your taxable income and get you out of those phase out ranges and increase this deduction. And you can do that through deductions. So really any deduction that would lower taxable income. It may be charitable deductions and itemized deductions. It may be business deductions. So it can be just the regular, ordinary deductible business expenses in the practice, or even those more creative ones that are not really necessarily high dollar amounts. Hiring your kids, or using the Augusta rule to rent out your primary residence to have a staff or leadership meeting or something like that. Even at small dollar amounts, if you're increasing this deduction while also getting a deduction for those costs, those can matter. Those can make sense. It's also pre-tax retirement accounts like 401ks and profit sharing in the practice, or at the extremes, cash balance plans. If you're relatively older, like 35 or older, and you have consistent extra cash flow and it makes sense. So those can be a substantial benefit if you're not only getting a deduction for that, but also increasing this QBI deduction. And you may also be impacting other things as well. For example, you might be lowering the additional Medicare tax, or you might be lowering the net investment income tax. So some things to keep in mind there is to plan carefully around this taxable income anchor. And the same thing with adding additional income. If you're going to be adding on additional income in any particular year, that may have a larger impact than just that marginal tax rate that you're in. So just keep that in mind. Plan carefully around that taxable income. Number 2 is entity decisions matter. So the type of business entity you have matters for a lot of reasons, but especially this QBI deduction, because this QBI deduction shows up differently in these different entities. For example, if you have an LLC and you're choosing to be taxed as an S corporation, you need to think more than just about self-employment taxes. That's usually the initial driving force with someone making that decision, because if you're below those thresholds where you start to phase out, the LLC will have a higher qualified business income deduction than the S corporation. Now, that's not to say that doesn't still make sense. It still very well makes sense. You're comparing a 20% deduction against a 15% or more tax, but just another thing to keep in mind. This actually may change potentially if your taxable income gets deeper into those phase out range, like you're almost to the top of it and phasing out altogether. The S corp may actually benefit more because the wages that you pay yourself can help preserve the QBI deduction and cause that phase out to go more slowly. So interesting thing about that is that wages can actually help you, especially if you are getting closer to phasing out there. Partnerships, we've talked about partnerships, and that guaranteed payments to partners do not qualify for this. Only your share of the business net income, of the partnership net income. And if you have an operating agreement that relies heavily on guaranteed income, maybe you're the one that actually is working in the partnership, and maybe the other partner is not. And so you use these guaranteed payments to make sure you're getting value out of the practice for your work, regardless of the profitability. You may want to revisit that partnership agreement or that operating agreement. Now, it's likely this has already been discussed since this deduction's been around since 2018, but something for you to keep in mind there. So any decisions do tend to matter. And there's a lot more that goes into the decision of what type of business entity to choose than just this QBI deduction. There's a lot more than just taxes, but this is something you want to weigh in that decision. If you're a C corporation, well, you're not getting this deduction. So it may or may not make sense for you to consider making a change. And next thing to consider is choosing a reasonable wage if you're the owner of an S corporation, or if you're taxed as an S corporation. Because when you're choosing that reasonable wage, you're needing to balance a lot of different factors. One of them is that with this QBI deduction, you have an incentive to pay yourself as small of a wage as possible. Because only the profit is eligible for the deduction, not the wage that you're paying yourself. Same thing with self-employment taxes. It gives you an incentive to pay yourself a smaller wage and have the rest of your distributions come from profit to save on self-employment taxes. So you have a pretty strong incentives to try to pay yourself as low of a wage as possible. But I want you to consider just balancing that against other benefits or requirements. Number one, you have a requirement really to pay yourself a reasonable wage for the work you do in the practice, whether it's as an optometrist or as an administrator or whatever it may be. Profit sharing in a 401k plan is going to rely on the wages in the practice. There's also state and local disability or family leave benefits that are impacted. So there's just other things that you want to balance out. Cash flow is just having a consistent amount of cash flow going into your household to cover your living expenses. Does it make sense to just cover that in terms of the wage that you're paying, the W-2 wage each pay period? So there's other things to consider than just trying to pay yourself as low of a wage as possible. Keep those other things in mind. And one last thing I'll mention is self-employed retirement accounts that impact the QBI deduction. Something I mentioned earlier is that your pre-tax retirement account contributions when you're self-employed, so a sole proprietor or single member LLC, when you're self-employed, your pre-tax retirement account contributions to a SEP, IRA, or solo 401k, those actually will lower your QBI before your deduction's calculated. It'll have to be subtracted from your net income. Same thing with deductible half of self-employment taxes. Same thing with self-employment health insurance premium deductions. So why is this important? Well, this is important because when you are contributing pre-tax to these retirement accounts, you are expecting to get a deduction. However, in this case, while you are getting a deduction for that contribution, you're also lowering the QBI deduction. So in effect, you're not getting a full deduction for that contribution. However, in retirement, when you're going to be withdrawing from those accounts, you're going to be paying tax on 100% of those dollars. So when you're putting money into it, you're essentially not getting a full deduction on that contribution. But when the dollars come out, it's going to be 100% ordinary income tax on that full dollar amount. So that doesn't necessarily mean that you shouldn't use the pre-tax version, but you do want to keep that in mind when deciding, okay, should I use a pre-tax retirement account or should I use a Roth-style retirement account, whether it's a 401k, a solo 401k. You do want to keep that in mind, is that it does impact your QBI deduction. These are deductions, they're good, but it does have an impact there that you have to keep in mind. Other than that, those are some of the basic things to keep in mind. So this is a really substantial, impactful deduction for business owners, whether it's a private practice, whether it's an independent contractor or a side business owner, sole proprietor, whatever it may be. Those of you who own pass-through businesses can really benefit from this in a major way. It just can get pretty complicated as your taxable income is getting higher. Again, I wish it were simpler, but unfortunately it's not. It's just the way that the tax code works. So let me know. That all being said, I know I threw a lot at you. If you've made it to the end, kudos to you. You are awesome. Let me know if you have any questions. Send me an email at Evon, E-V-O-N, at optometrywealth.com. You can find me on the socials, LinkedIn. You can find me in the ODs on Facebook group. Throw some questions in that Facebook group. I'll try to give you some information and education as best as I can. And then you can find the different resources and links mentioned in this episode in the show notes at the Education Hub at my website, www.optometrywealth.com. While you're there, check out all the other episodes and resources we put together, and feel free to schedule a no-commitment introductory call. We can talk all about the QBI deduction and how your practice is operating, or anything else that's on your mind financially. And you can learn about how we serve optometrists and navigating decisions like this nationwide. With that, really appreciate your time and your energy and your listening today. We have a couple really great guests coming up over the next couple episodes. So we will see you and catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.